Hi friends, welcome back to Quant Street's daily market review. This is the update for the session on May 14th, and let's take a look at what the market has to offer us today. The market was considerably higher compared to what it has been doing in the initial part of the week, and had a consequent 2 days of rise. Dow Jones rising 1%, Nasdaq 2.32%, and S&P 500 1.5%. So clearly it's a rally led by the tech stocks and the tech sector, which is also clearly visible. If you see here on the sectors, tech is up 2.5%, and all the other sectors also performing well. Utilities and healthcare relatively lower, performing below 1%. And we'll look at these sectors in detail shortly with the charts. So you can see most of the stocks, about 2,700 out of about 3,300 or 3,473 were green, and 600 declining. Let's take a look at the economic calendar. And today we had so the market's focus was retail sales and the inflation expectation survey by University of Michigan. So retail sales were actually, there was no growth, that was totally flat, same as about 10.7%, excluding vehicles 9%, and consensus was 0.8%, but actual is negative 0.8%. So it seems that vehicles and gas are both actually helping the inflation, and we'll see what's the reason behind that, why the vehicle prices are going up. And we understand gas prices are going up because of various reasons, oil rising, as well as the cyber attack on one of the major pipelines in eastern United States. Let's take a look at the consumer sentiment. Prior was 88.3, consensus 90.3, and actual actually declined to 82.8. And this is a survey run by University of Michigan. 600 households are questioned each month on their financial conditions and attitudes about the economy. So yeah, there is a decline in the sentiment, which lies aligned with the story of inflation rising, and we'll explore this further in detail soon. Let's take a look at the grid of the US Market Barometer. So small value stocks rising, as well as large growth stocks, which is mostly tech. Overall growth doing pretty well among all the size classes. Small doing really well, about 3%. Over 1 year, so again, small sector is among the value is 98%, and in growth is the rise of about 81%. Let's take a look at the movement of various important asset classes in the market. Russell is up 1.54%. IXIC, the Nasdaq ETF is up 1.22%, SPX 1.68%, oil also rising, as did TLT and gold, tracking at 0.26%, both of them. There was a decline in the US 10-year yield, so it's down at 1.628 and down by 0.42%. It was at 1.634 in the beginning of the session. Tesla, pretty modest gain at 1.5%. Ethereum and Bitcoin saw a decline, and VIX a sharp decline of 10%. So you can see a rise in the later part of the day after about 2 p.m. Otherwise, the market was relatively flat before that. Let's take a look at what briefing.com has to say about the retail sales numbers. So retail sales were flat month over month in April. The consensus for briefing was 1.8% rise, but it was an upwardly revised 10% increase in March, so it was already pretty high, and it's understandable that it remained flat for the month of April. Excluding autos, the retail sales declined, as we saw in the Vanguard dashboard. The key takeaway from the report is that the weakness was really driven by a tough sequential comparison. Moreover, the market won't be too concerned by the miss, knowing the hiring activity is going to increase and the wages will likely increase, and there will be a huge amount of personal savings at the ready to spend in the coming months. Motor vehicle and parts dealer sales increased 2.9% after increasing 17% in March. Electronics 17% in March. Clothing and clothing accessories 22%. So all in all, March was a pretty high bar to clear for the month of April, but you can still see some increases, especially for motor vehicles. Clothing and non-store retailer sales not so much, but food services and drinking places sales jumped 3% after a rise in 13.5% in March. So yeah, so sequentially a tough comparison, as they say, which is true. On the inflation front, so McDonald's and Amazon have announced to be raising their wages, and that contributes to the story of inflation, with increased hiring activity, rising wages, and increased savings rates. Expecting to have a lasting rise in the inflation. So Fed is still calling it transitory in nature, and Fed head James Bullard also noted that it's a judgment call on whether inflation is transitory or not. So let's move on and take a look at what RBC's thoughts are. So following a retail sales report which saw a blockbuster gain in both headline and core inflation sales driven by stimulus checks, warming weather, and broadening economic opening, the April report missed expectations. Headline retail sales remained unchanged while the core sales declined. Forecasts for the preliminary May sentiment are showing a rise above 90. That's for the consumer sentiment looking to climb back above 90, and that would be the first time since Feb 2020 when the index was measured at 101. So the reason being the same, that the fiscal aid, the gradual economic reopening, the unemployment, the rising wages, as well as this high savings rate, all contributing to a higher consumer confidence. Let's move on to take a look at the sectors. So the performer of today was technology. Over 1 year, as you can see, or since December, it has seen a decline in March, and again a decline in the month of May, and now moving back to a moving average. I think it's 50-day or 100-day moving average. Other performers in energy, which has been doing pretty good till March, then since then it has been relatively flat, doing well today at 1.61%. Consumer discretionary, it seems to be following the trend of technology, and it's risen 2.9%. Financials, consumer staples are flat relatively. Financials 0.59%, but look at the steady rise in financials with so little volatility. Healthcare declined strongly in March and is coming back. Industrials, again being the cyclical stocks in nature, has seen a steady increase, just like financials. Utilities has been rising since March, and since then it has been relatively flat. Communications again is showing a steady rise here. Among the subsectors, so yeah, airlines showing a pretty decent rise at 4%, although it's been flat since March. Broker dealer, sharp rise today at 11%, and the trend seems to be saturating over here. Chemicals, again a raw material, so it's inflationary, rather a cyclical stock. I think I misspoke about broker dealer, so it's risen 2%, chemicals 1%, disk drives a sharp rise after yesterday's or day before yesterday's decline. Hardware, an increase of 4% again. Anything of interest that remains, okay, oil services, a rise of 4%. Oil and oil services both tracking relatively. Oil services seems to be more volatile. So that's, I think, the story for the subsectors. Let's quickly take a look at the commodities. So the gold ETF rose about 1%. Let's take a look at silver ETF, again a % increase. So the gold and silver have seemed to bottomed out in the month of March and has been rising since then. And silver following the gold's ETF's behavior, and so does this gold and silver. I think these are spot prices of gold and silver. Anything else? So copper has been rising, but I've seen a decline this week. Pretty strong rise in copper as it's used as a raw material. US light crude oil up 2%, and that should explain the rise in other oil commodities. Natural gas was down, but yeah, let's take a look at some of the commentary from some investment banks. So most of the commentary has been about inflation, and the numbers we have seen for CPI, the retail sales, and the consumer confidence. And they say that the consumer inflation expectations are fickle. The last time inflation expectations were this high was in 2007. So they are commenting about the expected inflation rate for the next year rose to 4.6%. From 3.4% in April, but this high level of expectations didn't turn out that well in 2007-8 when the financial crisis struck. So the key is whether the increase will be sustained, and that has to be seen. I think that's the Fed Governor Waller said that the takeaway is that we need to see several more months of data before we get a clear picture of whether we have made substantial progress towards our mandate goals. Now is the time we need to be patient. And so the Fed is still playing a wait and watch game rather than giving into the market narrative of rising inflation, and they have confidence in their tools and experience to guide inflation back to the target once it seems to be scaring the markets. I'd like to move on to this report from Russell. Again, it's focused on inflation and CPI numbers. So they are talking about the rapid climb in airfare and hotel prices, roughly rising 10% last month, but they had a little pricing power last year due to the government restrictions. Now these sectors are starting to gain some pricing power. So this narrative is saying that these are transitory issues, which 80% of the increase in core inflation indicate that much of the steep rise in cost should fade over the course of 2021. as US economy settles, as life returns to normal. And the base effects, that's the exceptionally low inflation numbers last year, tend to skew the data, and they have done it for April and expected to do the same for May. And it does mean a bad news. A rising inflation does mean a bad news for growth stocks, as their cash flows are expected to be coming further in the future, which makes them more sensitive to discount rate dynamics than value stock. And the last report I'd like to talk about is this one from Schwab. Again, starting with the inflation talk, and they show this chart of hourly earnings, average hourly earnings, and employment cost index. And you see the spike in average hourly earnings when the low wage earners were out of employment during the pandemic, and slowly this has been going back to a relatively normal level as their employment comes back and the average hourly earnings return back to the expected range in the past. And so, given these distortions, they focus on the employment cost index, which accounts for the wage level mix shifts and has more modest uptick. As you can see, it's relatively more flat, the yellow curve for employment cost index. The strong economic and corporate earnings have already been priced by the stock market, as it says, they say that 90% of the S&P 500 index members are still trading above their 200-day moving averages. There has been a breadth of deterioration in both the Nasdaq and Russell 2000 over the past couple of months, as inflation concerns have put downward pressure on higher valuation segments of the market. So Nasdaq has seen a sharp down pressure. S&P is relatively flat. Russell also has seen declines more recently. So the essential takeaway over here is again the inflation scare causing a decline in the growth stocks, and the market is not that excited by the rise in earnings because of the costs being they were able to control their costs, and compared to last year their earnings are expected to be stronger, much stronger than last year. The outperformers have been cyclical areas associated with accelerating economic growth, namely energy and financials, which are the leaders year to date. And with this, they are highlighting the value, how it has outpaced the growth. So the story last year was mostly centered around growth, but as soon as the news of vaccinations started coming, there's been a consistent decline in the growth and a steady rise in the value. So that's a pretty striking chart to display. Let's see how globally the growth is being talked about. So the negative GDP of Eurozone is expected to become positive in the coming quarters as the Eurozone comes back to normality with the rising vaccinations, and the EPS estimates for Eurozone are considered to be higher than that of the US now in the coming months and quarters. UK being pretty strong, and the next is emerging markets. So here is a chart showing the trend of vaccinations, and the US has been trending downwards since April, whereas the Eurozone has picked up a faster pace of vaccinations now. And so the Eurozone seems to be following US and in terms of vaccinations and opening up, and is expected to return to a positive GDP and increased growth, and hence expected EPS numbers much better than US. Let's quickly take a look at the treasury yields, and the thing to be considered here is that the US 10-year has been at about 1.6%, and the other yields are much lower, so that's putting a downward pressure on yields as there's a bigger demand for the US bonds. But as soon as the story starts to reverse, there will be demand for bonds in other countries, other sovereign bonds, and that is going to lead to a rise in US yields also as the demand for US bonds goes down. And finally, I'll talk about the real yields, which aren't reflecting a strong economic outlook. So even though the expected yields or the yields so far have been flat, but the rising inflation is making the real yields go negative. And so a lot of things covered here in this report by Schwab, and really appreciate their storytelling and with the help of charts. Let's take a final look at the monthly trend. Mostly consistent. Ethereum up more than 50 or about 60%. The SPY is back above zero, and the other two are negative, Russell and Nasdaq. In terms of sectors, again, the energy sector is the leader, followed by financial, and the story is still the same. In terms of metals, again, metals leading the pack among commodities, and oil is there somewhere in between. Again, a gain in bonds today, but overall TLT is negative 0.2%. FANG stocks, a couple of them become positive over the last 30 days. Google is still negative, or rather it's positive, but Facebook is negative, and it's not. Google and Facebook among the positive ones, and the rest of the pack is still negative. So that concludes my summary. Pretty long one, this one. Thanks for tuning in, and appreciate your time, and look forward to sharing more insights in the next video. And Quant is signing off. The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.